For more on the markets this morning, we want to bring in Ashish Shah. He is Chief Investment Officer of Public Investing at Goldman Sachs Asset Management. And Ashish, a lot of people look around at the markets right now, and even though we've been at or near all-time highs, there is some concern, and that concern plays out in the Treasury markets. What do you think right now? How do things look?
So, first of all, we think the market here has runway. We like risk assets in general, but without question, there's been crowding and momentum going on within the market that is real cause for concern, particularly if the Fed ends up staying higher for longer.
What do you mean crowding and momentum?
So, we've seen momentum stocks do better than they have for really 15, 17 years. Going back to periods of time that really should concern us. And so, that's the kind of environment where you ask the question of what can I do to prevent myself from being exposed to a drawdown, a sell-off in the market that's sharp and violent. And, I think a lot of investors are worried because the money's been really easy to make over the course of the last 6 months. You've seen kind of the AI rally that's been fantastic, and it's generated a lot of return. And AI is a fantastic long-term trend, but there's going to be crowding when popular trades kind of get rinsed.
So what's the answer to that question? What can you do to protect yourself?
We think that there are a couple things going on, and they're already starting to take place within the marketplace, which is investors are looking for diversification and other themes to play that are long-term themes, but still represent value within the marketplace. So I think within the U.S., we're seeing kind of a broadening of the themes that we're seeing, particularly around industrials, right? So people are asking, if there's going to be this AI build out, how do I play it through the industrial space? Is it data centers? Is it literally, steel? Or electricity to power the data centers. I think when you look more globally, what we're seeing is actually that you look to Asia, places like Japan, like India, and you're seeing real long-term stories that are driven by structural trades within the market, where companies are improving their governance, and that's unlocking a lot of value. I mean, India could end up being a decade of growth that really kind of propels the economy. And there's going to be all sorts of plays from consumer to infrastructure within that. You don't just have to bet on AI.
Do you think some of those markets, like in India or Japan, are a better place to invest than here in the United States?
I think that they're equally good. The U.S. is beachfront property without question, right? We have the density of talent and resources within this country to really drive forward this next generation of technology. But there's, you look at U.S. stocks and they've gotten expensive, right, by most measures at the top line. Now, within the market, there's kind of the normally priced stocks, but then there are stocks that are doing really well as a function of AI, and that's where the risk return is changing. I think when it comes to the bond market, right, you have real rates that are very high because of this growth. The Fed's been hiking. They're now looking at pivoting, and that may end up resulting in kind of an opportunity to again diversify, particularly if growth slows.
I know you were sort of listening to our last guest. He had some concerns about the idea that buyers for U.S. Treasuries could disappear or go on strike at some point if they don't like what they see in future budgetary lines and the direction we're headed on things. Ray Dalio was speaking just yesterday and saying that he's concerned. He thinks there's a 50-50 chance that there's some sort of a civil war or civil break in the United States where the states can't get along and no longer agree to abide by federal laws that exist. Those are some pretty dark doomsday type scenarios. Yeah. Do you worry about any of those things?
Look, I think when you're a long-term thinker and a long-term investor, all you do is worry, right? But the question is, what do you do about it? Because you're sitting in cash is a long-term losing game.
Yeah, right.
And so I think the first thing you have to do is ask yourself, are there things of value here in the U.S. that, regardless of where you sit, are going to continue to be valuable and grow in value over time? And I think without question, the U.S. has a lot of assets that pair with those liabilities, that debt, that are going to actually, guide us through the next periods of time. But there have been times when the dollar has been weak, and right now we're at a point where the dollar is strong. And so it makes a lot of sense to look outside the U.S. for growth stories, for long-term growth stories where you can generate returns. But, look, the rule of law in the U.S. is why the U.S. is actually so powerful. The fact
but I think that's what Dalio's point was. Rule of law may not continue to exist if you see states ignoring federal mandates that are there, federal mandates completely disregarding what states think about some of these things.
Look, you go back to the history of the U.S. States and the federal government had fought for a long period of time. It's one of the fantastic things about our system of government is that our government actually competes, right? And that creates an environment where, ideally, investors and entrepreneurs can build businesses and do it in an environment where there's not going to be 100% certainty. But you look back at the last 100 years of this country, when has there been actual full certainty? Right, I think we're being a little bit spoiled.
There never is. You're right.
Yeah, but it's a real reason to be concerned and to make sure you're voting and being vocal when it comes to policy.
You say that if investors have been waiting for a signal to extend their duration in treasuries or in bonds overall, maybe it's too late.
So I want to take everyone back to October when we hit 5%, right? Everyone at that point was talking about how there was going to be no demand for treasuries and the U.S. government had to issue so much. And then we had over 100 basis point rally in the 10-year note. And the reason for that is because when you see that pivot, right, everyone's going to come out. And so trying to time it perfectly is going to be an impossible task because you see growth slow and the Fed has a lot of room to cut here. But we don't know when that's going to happen. All the talking heads, anyone that is, at the Fed, they're dealing with uncertainty. And so the reality is, if you're an investor, if you're trying to build a portfolio, you want to buy enough bonds that you're not going to be regretting not locking in that long-term yield.